All right. Good morning, good afternoon, traders. Today is Wednesday, February 11th, 2026. This is You've Got Options for Income Navigator. Let's have a look at the markets. And by markets, I mean we're looking at the daily chart of SPY. And as I pointed out earlier today, that we are stuck in this. I don't know if we can call this channel, but we definitely have two pretty obvious levels of support and resistance. We've been bouncing around in this area. Well, let's call this from about end of November of last year, right? Where the market was, well, it looked like it was about to roll over, and we didn't. Rally back up, chopped around, made a new high, rolled over, buyers stepped in, took it back to all-time highs, and actually made a new all-time high. Uh, this is end of January of this year, so this was just a couple of weeks ago. And then again, and the buyers stepped in once again on SPY. This is around six. Let's call this 675. And then we saw a reversal on a Friday. Monday, Tuesday was yesterday, was kind of a inside day, we would call it that. It's not necessarily bearish, but the market does feel a little heavy. And today we had a nice gap up that was sold into, which is not a bullish sign. If you want to make the bull case, you don't want to see sellers come in and roll the market on the gap up. If anything, we wanted to see some follow through to potentially squeeze more shorts. I don't know how many shorts are out there betting on market going lower, but I think what might happen is that if we do break out and S&P takes out 7,000 with any kind of conviction, I think there is not so much that there's a ton of shorts waiting to cover. I think there's a lot of investors that are on the sidelines that will be forced to chase, right? And then we know that when the market takes out all-time high and the price has never traded at around these levels, there's very little supply, meaning why would anybody say, okay, we're making an all-time high, now is my chance to go and sell my holdings, right? Or short the market. Why would you want to get in front of that train? So what happens is there's a huge imbalance of supply and demand. If there's no supply and there's a lot of demand from those that have been sitting around on the sidelines waiting for the market to either roll over or do whatever, and now the market is actually moving higher and running away without those investors, they are forced to go and chase. What tends to happen is when they chase and they buy, not necessarily SPY, they could be buying whatever they are buying. Maybe they are going out and buying call options, right? Because they're saying, well, the market it looks like it's breaking out. I don't know if it's going to stick. You know what? Instead of committing a bunch of money to the market at these levels, I'm going to go out and buy some call options, right? Because that's what options are designed for, to protect you against risk of market running away without you. They'll go out, buy a bunch of calls. What happens is the dealers that are selling those calls are now net negative delta positioned, and they have to hedge off their risks. So what they do in turn, they turn around and they buy futures and they buy the market, and it just kind of feeds in itself and the market runs away. And the more buyers there are, the more dealers have to hedge their risks. And until we see an aggressive move to the upside, I think that party could go on. Something very similar that we saw in GLD. Obviously, prices of gold, everyone's been following. GLD here, you see how aggressive this move happened. It isn't because the demand for gold was necessarily there, or the demand was there, but the reason why, right? The reason why we saw this aggressive move with a very aggressive move to the downside to follow was because whoever was maybe short gold, maybe was sitting around and waiting for higher prices and then realized that, this gold is running away without them. They went out and bought a bunch of options on gold, right? Which forced the dealers to go out and hedge off their positions. And that kind of took off. And the reason why I think that, this is exactly what we saw as far as market participants buying options, driving IV higher. We see this in the price of GVZ, which is the gold volatility index. You see how volatility completely blew out on that move higher, and then it hasn't really returned back to the mean, but it's definitely way off the highs of around 50. Now IV for gold is at around 30, right? So is this what we're going to see with SPY? Maybe, maybe not. But the idea, right, when the asset starts to take off and everybody's chasing by buying options, this forces the market makers and whoever's selling those call options to go out and hedge their risk and potentially drive the underlying asset even higher. While this is all going on and we're seeing the market chopping sideways, and again, when I say market, I normally look at the S&P 500, SPY or SPX, because this is what professionals use when they're trading. We have quietly noticed that IWM, right, has been taking the lead, right, and now in the last couple of weeks, it's just been kind of quiet, right, back and forth, but still above all key moving averages. So we can continue to make the case that the trend, longer term trend in IWM, is still up. But if we look at Dow Jones, right, and this is one of those, we used to call it, this is a mom and pop. Nobody follows Dow Jones because it's only made up of 30 stocks, right? These are old, boring companies no one cares about. But look at how Dow Jones has been continuing to trade higher. And as a matter of fact, it wasn't the most encouraging candle if you look at yesterday's candle, but it did make an all-time high. Whereas SPY, right, very close to an all-time high, but the story is quite different. And then I also like to look at relationship between different indexes. And if we look at Dow Jones and how it has been trading relative to S&P 500, all right, we can look at something like this, where you can see that Dow has outperformed S&P, right, for quite some time. But if we zoom out, you can see that over a long period of time, S&P has outperformed the Dow, right? So the safer assets, which are the 30 mega caps that make up the Dow Jones, right? They have underperformed S&P 500, right? But in recent months, and this is, going back to about October, since about October, the Dow 30 stocks have outperformed S&P. Not every single day, but the trend, if we look at the relationship of Dow Jones versus S&P 500, right, there's higher highs and higher lows since about October. One thing I was looking at is that when do we see this kind of movement in the price of, let's call this is the relationship between Dow Jones and S&P 500. Right, this is definitely a risk-off behavior where money goes towards safer assets. Okay, what are the times where we noticed this kind of behavior? Well, let's look at, for example, 2022, which, as we know, was a down year. I think S&P was down about 18% on the year or so. Right, so the markets were down, and I'm pretty sure that it wasn't just S&P 500. The market overall was down. The Dow was down, Nasdaq was down, S&P was down. But if we look at the relationship between Dow and S&P, again, both might have been down in 2022, but money was rotating out of S&P and into Dow Jones, right? So the money was going towards safer assets. Am I saying that this is what's happening right now? Maybe, right? It's kind of early to tell, and it only becomes obvious up here when the market is way down, and then you look back and say, well, Dow Jones has outperformed S&P 500. We're not looking for winners or losers. We're just trying to identify what's happening. Have we seen similar behavior before? And what does that mean for the markets going forward? Right. So for right now, I think the market may be near an all-time high, right? But based on what's happening between, Dow Jones and S&P 500, there's definitely rotation that has been going on for quite some time. And it looks like the money's flowing out of riskier, maybe overvalued companies towards some of the boring old companies like for example, Coca-Cola. And you can see what Coca-Cola has done in the last, not just in the last 6 months, but most recent, right? So this is since about the beginning of the year. Another one is ExxonMobil, right? Pepsi was another one. These are staples, right? These are the companies that don't really care if the economy is up or down. We can't stop drinking soda and smoking cigarettes. So these companies are trading higher. Walmart was another one, right? That's continuing to make high. So nobody wants to chase the next AI company, the next AI chip maker. The money's rotating towards the boring companies like Walmart, Coca-Cola, and Pepsi. So we'll definitely keep an eye on, how this continues to develop. And if we just wanted to look at maybe different sectors, XLP, which is the consumer staples, right? As I said, the cigarettes, the soda, the toothpaste, the things that you don't really have a choice whether or not to, I mean, you have a choice to buy or not to buy cigarettes, but as far as, toothpaste and soda, maybe not so much. But anyways, we're looking at the relationship of XLP relative to XLK, right? XLP versus tech has outperformed. We can look at another one is XLY, which is the discretionary, right? Those discretionary stocks have underperformed and kind of looking like they're about to roll over, right? We're below key moving averages, 8, 21, and 50. And it looks like 21 is now crossing below 50-day. That's not bullish. So we'll see what happens there, right? So there's very little to make the case that the market is super bullish. Um, the reason why the market hasn't completely rolled over is because, there are 10 or 11 sectors in the S&P 500. Not all of them are rolling over completely. You have the financials, XLF, right? That's kind of just trading sideways, but not really completely rolling over. XLE Energy is about 15% weight on the S&P 500, so that's kind of holding things up, right? So there's definitely, if I would have to call it anything, I would say that, the best case we can make here is just rotation from one sector into another. So that's why indexes are kind of holding up, but some of those stocks that everybody was all over on the way up are now down, right? For example, Robinhood. And this is not to pick on any individual company, but you look at on the way up, look at this move, right? In 2025, right? The stock went from 40 to 140 or 150, right? Everybody was out there saying that this is the next Charles Schwab. They're going to take over the world. Now it went from 150 to 70, got cut in half, right? You don't hear too much about it. And it's fine. You look at, I think Shopify was another one. Also, big move, right? Risk on, money's piling in into risky assets. And then these risky assets have underperformed, and the money's coming out of these riskier stocks and going towards safer sectors. Energy is clearly outperforming all other sectors in the S&P 500 this year. Let's talk about volatility for a second, right? So we're looking at the chart of VIX, right? What is the VIX telling us? Well, the VIX is kind of stuck in the middle of nowhere. And, historically, I think the average number for the VIX, which is expected forward volatility annualized, is at around 18, right? So VIX at 18 is normal, right? There are times where we go into the low teens, right? Market's very complacent, not expecting a whole lot of volatility going forward. And then we get reversion to the mean. Sometimes we get these moves into the 20s, which, historically is relatively high. And then we revert back to the mean. And occasionally we get these blowouts. These are more event-based volatility spikes, right? But right now, volatility is just normal, right? The market is not pricing in some crazy volatility going forward. Well, how do we know? Well, what does the VIX tell us? The VIX tells us about the demand for options in the S&P 500. These are both calls and puts, right? And right now, the market, or if we're looking at the VIX and we're trying to figure out, what is the market anticipating going forward, right? There isn't a great demand for protection in the S&P 500. Now this, we can go one step further and make the case that, well, if the calls were being bought and the puts were being bought, the VIX would be much higher. And that is true. What happens if the market participants are buying puts and they're selling calls? That kind of keeps the VIX more or less balanced. And if the market participants are selling 2 times as many calls as they're buying puts, this can actually drive VIX lower, while overall activity, I don't want to say that it's bearish, but it's definitely hedging, right? If you're buying one put and you're selling 2 calls to pay for it, right? This is a, well, it's a bearish activity. It's definitely a hedging activity. It's not a straight up bet on the market going lower. You're just buying protection and you're selling upside premium to pay for that downside protection, right? But the VIX does not register that as an anticipation for markets going lower. So VIX isn't always the right tool to use if we're trying to understand what does the market think about volatility going forward. For that, we need to look at VVIX, which is the VIX of the VIX. This is what tells us about the demand for VIX options. Now, if the overall market participants were looking for higher implied volatility going forward, right? They can buy puts on S&P 500, they can sell calls on S&P 500, or if they were just looking for more uncertainty going forward, they can go out and buy calls on the VIX itself, right? And this would register with VVIX, which is the forward expected volatility for the VIX itself. And you can see that, this is also a mean reverting vehicle where we highlight areas of, in relative terms, when the volatility of VIX itself is high, and that's when things become too expensive to chase. And typically, this kind of signals a potential mean reversion in the demand for VIX options. And then there are times of market complacency where it makes sense to buy VIX options. And when I say VIX options, we're talking about VIX calls because, right, if we're looking at volatility, if we were looking to make a profit from an increased implied volatility, we would be looking to buy call options on VIX. And we want to do that when, relatively speaking, the implied volatility for VIX options is low. Right now, where are we right now? Well, I don't need to tell you. I think you can see yourself. If we're going to use, right, this chart, sure, there are times when demand for VIX options gets blown out, right? If the VIX is going through the roof, think about April of last year, right? VIX was going all over the place. We would go from 20 to 30 to 40, back to 28, back to 35, right? VIX was moving around a lot, right? So demand for VIX options was going through the roof as well, right? The market participants were betting on the more volatility going forward. And then eventually it all died down. But for the most part, you can see that VVIX will trade within the range. We can call this high end of the range somewhere around, well, I don't know, maybe 115 to 120. If we're at 115, 120, this kind of signals that, the market is not falling out of bed, but, the demand for VIX option is relatively high. This starts to signal that the market participants are probably starting to overpay for the hedges. And then if we see the VVIX somewhere at around 90, this tells us that the market isn't reaching for VIX calls. The market's not anticipating volatility going forward to pick up. And this would be the time to look at buying or placing some kind of volatility hedges. Right now, we're at about 100, so we're between 115 and 90. There's not a clear sign that the market is looking for, some kind of a blow up. So that's why I think this supports the case that what we're seeing in the marketplace right now is just a very basic rotation from one sector into the other. Anything that was the best pick last year is probably not the best pick today. Etsy was another one I looked at today, right? When risk is on, look at last year, right? Risk was off for quite some time and then risk was on. Things like Etsy are all the way up and now risk is off. Doesn't mean sell everything that isn't nailed to the floor, but money's rotating out of those risky stocks that can move 100% in 3 months, into stocks that don't normally move like this, such as Walmart, the Coca-Colas, and the Pepsis. What does that mean for us? Well, if we're playing a lot of individual names, we're exposed to a single ticker risk, right? One stock goes up, one stock goes down. Depending on how you position, you're either going to make money or maybe you won't. Good example is Microsoft. What's Microsoft doing? I know I have a lot going on, bear with me, but we talked about Microsoft. At some point before the earnings, there was a pretty aggressive call buyer. I don't know whatever they did. We can look at what they did with those calls if they're still in it. Those calls are gone. But after earnings, Microsoft gapped down. There was continuing selling. We filled the gap going into the earnings event back in May of last year, right? And last couple of days, they try to rally or they try to bounce Microsoft, but you can see we're still way below all key moving averages. Trend is still down. Is Microsoft going out of business? That's the question you want to ask yourself if you're looking for some longer term positions. If you're looking to build longer term positions, all of this, there's going to be a lot of noise between now and whatever your long term is. If you think that August of this year is your long term outlook, it's not. It sounds like August is a long time away, but it's not. Right? You want to talk about a year or more out in time. So, sure, between now and then, in my opinion, there's going to be a lot of noise. I don't know if Microsoft's going to go straight up or if it's going to continue to go straight down. But just looking at what has happened before, I think that we are closer to some kind of a turning point than we are towards a complete meltdown. I could be dead wrong, and I'm not saying that I have it all figured out, but if we just zoom out a little bit, look how far Microsoft has come, right? And then there are times when Microsoft goes up, then it goes sideways, and then it pulls back. Then it goes up and it goes sideways, and then we don't care about the why, right? Earnings, or if it's risk on, risk off. They have too much exposure. They're over invested in AI. AI right now is not what it was 6 months ago, right? But I think at some point that story will come back around. And I think longer term, this is going to be an opportunity just like this was, or this was, or any other pullback, unless something has changed and you think that Microsoft is done, this is going to be a ghost for the next 10 years, right? Then it doesn't make sense to do anything about it. But I think that building some kind of a position in Microsoft longer term, for me, I think it makes sense. And the position that I put in Microsoft, I'm going to switch and to Option Explorer, and I want to talk about what I'm doing and what I'm looking at while doing it. So bear with me. Let me switch over to here we are, right? Put this trade on 1 day ago, which was yesterday. Stocks down 3 standard deviations based on whatever implied volatility was yesterday. You can look at a chart, right? Not so pretty, but if you're and again, I'm not saying that it's going to go straight up from here. Maybe it will, maybe it won't. Right now, the trend is down. Is the trend down mean it's going to go down every single day? I don't think so. Sure, there are going to be moves higher to potentially make a lower high, and then we could potentially make a lower low, right? But that's yet to be seen. But right now, there's some indication that things are maybe a little overdone, right? We have RSI is close to 30. You have MACD way below 0 and still bearish, but they're starting to kind of flatten out a little bit here, right? We've tried to take out the 8-day EMA. We failed yesterday, and today is not looking any better. We're down about 1.5 standard deviations today. So as a result, the net result right now of this trade. This trade is down. Is it a bad trade? Well, if you bought it to day trade it or to swing trade it from yesterday to today, this is a horrible trade, right? But my plan for this trade is a little different. Number one, number one, we want to think about size of the trade, right? No one trade should be big enough where a loss of, whatever your predetermined dollar amount or percent of your risk in the trade, it shouldn't translate into a large percentage of your overall or total account, right? From which it's kind of hard to recover from. Meaning that while this trade is showing a loss of about 7%, 7% of what? 7% of what I had to put behind this trade to get in. What did I put into this trade? Well, I paid $16,200 for it yesterday, right? This $16,200 should never, at least that's my guideline, should never be anywhere near a 10% of an overall account value, right? So you kind of want to plan your trade ahead. Think about, is this an all in, all out type of deal? Am I going to break up my entry into 2 or 3? What's my total trade size? Well, if my total trade size is, let's say, $40,000, right? I don't want to put more than $40,000 into this Microsoft long-term bullish position. Okay, here's my first tranche. It was $16,200. Well, it's down today. Okay, it sucks. Now what? Am I going to add to it right here? Probably not, right? I want to give it a little bit more time or to see which way it goes. Right now, it's not looking good. And sure, the ideal time to add to it is on the way down, right? To improve this position. So sure, I may be able to scale into full size position on the way down. Maybe I won't. I don't know. One thing I do know is that while I'm holding a long term or longer term, right? My leap that I bought is in December 2027. December 2027. So that's my long-term play. I would like to add more to it, not yet. In the meantime, while I'm holding on this December 2027 call, which is at 280 strike, I sold a March 20th 445 call, which is now 37 days away. As we can see in this darker gray area is the expected move for March 20th. So the underlying could be somewhere inside of, let's call this 438 down to about 370. Well, let's see what happened here. I sold the 445 call yesterday for $6.25. Now, one day later, and the stock down, this call is trading for $2.65. I can possibly collect the 50% of max potential profit from this call. It's kind of helping my long-term position, but not really, right? The long-term position is what's really down. This short call, right? So it's up some, 350 or whatever, right? It's not really helping a whole lot, but it'll help if we do the same thing over and over long periods of time. So one way I can play this is I will say, all right, I'm going to sell short-term calls against my long-term positions. And if I'm able to capture 50 to maybe 70 or 75 or 80% of premium in these short-term short calls, I will get out and reset. So one thing I can do, I can buy to close the 445 and then go out and sell what else is trading for around 6.25, 650. It's 425 and sell a 425 call. Whoa, let's look at this risk graph. The blue line is my current risk graph, which looks fairly decent, right? This green line is the adjusted risk graph, which looks like I'll be giving up all of this potential upside, right, in order to capture another $3 or so, 385. which may sound like a good deal to some and may sound like a terrible deal for others. And this is the greatest part about what we do here is that if it's a good deal for me, but it's a terrible deal for you, you don't have to do my deal, right? You can do what makes most sense for you. I'm going to try to explain why this might make sense and how I would go about it. If Microsoft continues lower, right, I would expect to make a little bit more money from this short 425 call, which is a good thing, right? Yes, my long term leap that I bought is going to continue to take pressure, right? But again, I don't think that Microsoft is just going to continue straight down. It may, but I think that we're going to see some kind of a bounce, right? So until that bounce comes, I'm going to try to sell these calls aggressively. I don't really want to go in the money. I don't want to go at the money, right? But if we do get a bounce, and let's say in the next couple of weeks, this is the expected range. Did I do that right? Yeah. Right. So this is the expected range. This is the expected range for T plus 21. So if I roll the 445 down to 425 and collect another $385, and then in the next 21 days, if we're somewhere around the expected move to the upside or higher, I will still have positive delta, which means that I will continue to participate to the upside. Yes, my profits will have been reduced, right? And that's the negative. But the opposite or the flip side of that coin is that I gave up some of that potential profit in order to capture another $385, right? There's two sides to every coin here. There's no just give, and no take. I'm going to take a little bit more credit and give myself a little more room to the downside. It's insignificant today. But if I can do that every 30 days over the course of the next, 15, 16 months, it's going to make a difference. So for right now, I'm cutting off my short-term upside in exchange for a little bit more credit, and I'm okay with that. Because what happens if Microsoft runs to 430, okay? If it runs to 430 and I sold 425, let's say for $6.40. Well, let's round this off. If I sold it for $6. If I sold 425 for $6 and in the next 21 days, Microsoft is at 430, now this call is worth $5, which is the intrinsic, plus whatever time value at 16 days until expiration. So odds are this 425 is going to be underwater. Okay, it's underwater, right? It has 16 days to go. Maybe it's trading for, let's call this 750 or $8. I will then buy it back for 8. So I will have lost money on this 425. I lost a couple of $100. I made a couple of $100 on this 445. So I'm close to even. My leap is now back in the profit because I can see that at 430, 21 days from now, I would expect this position to show a profit of about $400, right? So I care about the running P&L. I'm not going to try to make money on both the leaps and in the perfect world, that is the best case scenario. Is it going to work that way? Absolutely not, right? There are going to be losses somewhere and there are going to be profits somewhere, right? So if I'm going to make a profit long term, I'm going to try to keep my short term losses to a minimum. And if I'm going to lose money long term because my bullish position actually turned against me and the stock went down, so I was completely wrong on my directional outlook, I want my short term short calls offset some of the longer term losses, right? That's the goal and that's the plan for this trade. Again, if you're just going to focus on my short-term calls that I sold against my lead, what an idiot, why did I do it? Now I'm losing money on these short calls. They're in the money, intrinsic, extrinsic. It doesn't matter. If you keep good track of all of your trades within this trade, right? Meaning all of your adjustments or all of your tranches or whatever you want to call these short-term income trades against your longer-term bullish leaps, if you're able to mark everything to market and understand where your trade is as far as your running P&L, and if you're using some kind of visual tool to kind of tell you, because guess what? If I roll this 445 down to 425, Microsoft goes down. I roll this 425 down to maybe 415, right? I'm making money with these short calls on the way down. And then Microsoft turns around and rallies hard against me. Do you think you can possibly guess where you are as far as, well, you can mark everything to market on your spreadsheet and understand where you are as far as your P&L, but can you tell how much further can Microsoft move up before you start to accumulate losses? Because there is going to come a time where there's risk not only to the downside, but to the upside as well. And that's where a lot of traders get kind of lost, right? They make all these adjustments. They, you know, even if they keep a pretty good spreadsheet with all of their transactions, they don't realize where that upside risk kicks in. So all I'm saying is if you're able to know your running P&L and where you are as far as this 10 goes, it's just a lot easier to say, all right, we've made some adjustments. Now we're, let's say maybe we're somewhere here, right? I'm still net positive delta, so it's not the end of the world. If we continue higher, I'm going to make a profit because I have a positive delta. It's just not going to be as much because my short calls are offsetting my long call. These short calls, negative delta is offsetting the positive delta of the leap, right? So we only have 15 delta instead of like a 90 delta or 85 delta. So we're making less for every 1 point move to the upside. But as long as I stay inside of this 10, this trade is going to be okay. Even if I have to roll my in the money short calls, I just don't want to pay a debit. So I'm going to try to figure out where and how I can make an adjustment of these in the money calls, right? Without having to pay too much debit for it. And if I am paying a debit, where is that credit going to come from to cover the debit? I know that let's take a look at questions, and we can talk about the intrinsic and the extrinsic. And if you only focus on one or the other, unfortunately, you cannot isolate one or the other, right? Because there may be a time where, your short call goes in the money. If you're forced to roll this in the money call, you're forced to buy intrinsic value. And if the call that you're selling does not have any intrinsic value, that means that the difference between your in the money call and at the money call that you're selling is the intrinsic value, and that's your debit. And then you end up taking that loss. And if the underlying will reverse, right, that intrinsic value that you just paid, it was unrealized in your leap. But if the underlying is going to reverse and erase any unrealized value in your leap, which was your intrinsic value, you end up with a net loss of whatever you paid for that intrinsic value, right? So there's ways, at least for me. I would like to, if I'm making an adjustment, I would like to recover that intrinsic premium that I'm paying by either rolling the leap, but there could also be a chance that if, let's say, on the way down, I make adjustments, I sell covered calls against my leap, and then the underlying is going to reverse and trade higher, and I'm forced to roll an in the money call, and there's a debit. If I move my leap, the leap may be below the original purchase price, right? So I would be locking in the loss both on the short call and on the leap as well. So that's why it's important, in my opinion, to keep a good spreadsheet so that this way you know your cost basis on each of these two legs. It's important to know your cost basis on each of these two legs. You should also know when you can and when you can't move the leap. Do you really want to move the leap right away? Maybe if you have to roll an in the money call, I would make the case that if that happens, don't let it go too deep in the money. You don't want to pay too much intrinsic value for it. All right. So maybe if the call that you sold at a delta 30 goes to delta 70, move. Don't wait for it to go to delta 90 and too close to expiration, because now you have nothing but intrinsic to pay back. And then what are you selling? Are you selling another call with no intrinsic, only extrinsic value? Where is the difference going to come from? Technically, yes, that difference will be covered by what your leap will have gained, but you don't want to leave that on the table either, because what happens if the market's going to pull back, right? Let's have a look at some of the questions from you guys. Can you discuss your choice of buying leap call versus selling leap put to execute these covered calls? Yeah. I mean, without going into, and I think this is a topic by itself. We can talk about this in more detail, but if you're comparing buying a leap call versus selling a leap put, it's completely two different animals, right? So you can't replace one with the other. There's no way. And very quickly, let me tell you or show you why. Let's just use this August 26th, August 2026. This is I believe this is a monthly expiration. Let's use this with 191 days in place of the leap. But if you go with the leaps 400, 700 days away, it's going to work the same exact way. If this is what the risk graph of an in the money long call looks like. Okay. Your downside is capped. It's limited down to what? To the debit, what you're paying for it. You're paying $10,500 for it. Your downside, this is the most you can possibly lose. If the underlying goes to zero and you bought this leap, you cannot lose more than what you paid for it. Your upside is unlimited. Your downside is limited, right? So, and you have 88 delta, which means you'll make 88% of what your stock position would look like. If meaning for every 1 point move, instead of making $1 or 100 cents, you'll make 88 cents. Right? So it's going to move very closely with, as far as P&L goes, it's going to mimic owning 100 shares almost, but it'll cost you way less. Right? This is the reason why we use in the money leaps as stock replacement. Now, if you want to talk about we're comparing this to selling leap puts. Well, leap puts at what delta? That's question number one. If you want to talk about, let's go and, if we wanted to achieve the same, right, 88 delta, how would we structure a leap put to capture 88 delta? Right, we would sell away in the money put. Right, that gets you about 83 delta. So very close to stock replacement. However, right, you may say, and it wouldn't be wrong to say, well, the upside is capped, but yeah, Microsoft would have to rally like 70% before that cap kicks in. So downside is not necessarily capped, but your downside is not protected here, right? So while the slope of your T+0 and your risk graph at expiration is similar, your downside is not capped here. And it may take very little margin up front to put this trade on, but you absolutely have to plan for volatility expansion. I mean, if we go through something like, I don't know, what was Microsoft or whatever the underlying is, you want to prepare for the worst case scenario, right? If in 2022, just looking at the price of Microsoft was down 40%, right? If you put this trade on and Microsoft is down 40%, you will lose, well, according at least, and this software isn't the best. You have to understand what your margin requirements are. Are you in a portfolio margin account? Are you in a Reg T account, right? But according to this software, I think your initial margin is going to be somewhere around between $5,000 and $8,000 to short a 700 put in Microsoft, right? But on a 40% pullback, you're down 15 grand on an initial, $8,000 buying power reduction. That's a lot, right? Which means you're already in the margin call. Now your buying power requirement is way higher. Plus, you're at a drawdown of about $15,000, right? And on the way down, you don't get any delta relief. Whereas an in the money leap and in the money call leap will lose delta on the way down. So on the way down, your P&L will be a little bit smoother. It still doesn't help. It's still going to be a losing trade. You will still have a drawdown, but it's just going to not feel as terrible. And again, like 40% move down is kind of an extreme, but it can happen. So you kind of want to, you never want to say to yourself, "Oh, this could never happen again." Like those are the words that traders die with. You don't want to say this will never happen to me or this will never happen again. So you kind of want to plan for the extremes. So if you wanted to make the case that the P&L is similar, sure, P&L is similar to a certain degree, right? Upside is limited, downside is not protected. You don't have any delta relief on the way down. It's going to be a lot more painful on the way down doing an in the money leap. Another thing about an in the money leap put is that it's in the money. Sure, there's 191 days, but if you look at the extrinsic value, and this is something you have to keep an eye on, there's 10 cents of extrinsic with 191 days. You can walk in any day. You can walk in any day to being long 100 shares of Microsoft at $700, and you have to put up 70 grand in a cash account, right? So there's things to think about here. But starting with the risk graph, I don't want to do in the money or this deep in the money puts. It's just not my style. Hopefully, this answered your question, Michael. And you're saying my question stems from Tom's, where he sells covered calls on positions. Where he sells a covered call on positions like Palantir 80 put. Let's see. I don't know exactly what the trade is. I would need to look at, and look, there's no right and wrong, right? But I wouldn't want to be, well, selling an 80 put on a stock that's trading at 134. Is that where Palantir is right now? Right, Palantir is at 134.87. So even if we go out and we go far away in time, 300 and let's say 38 days, selling a 80 put, which is not in the money, it's out of the money. It's an out of the money put, which is not a terrible trade at all, right? You get the premium, you get the positive delta. You don't have a lot of delta, but you also have some room to the downside, right? And you have the time to eventually be right, right? You can see a T plus 0 is pretty soft on the way down, not as hard as it was by selling an in the money put. The only thing that is different here is that, yes, this is a bullish trade. This is a bullish trade, but your upside is capped. You have a limited upside. You can still make money, but your amount of money is limited to the amount of premium you're collecting on this put, and then you can boost your income by selling short-term calls. Right here. Maybe, I don't know, you're selling slightly out of the money calls to take advantage of maybe some downside action in the near term. Just not, I mean, this isn't the kind of risk graph that we may be used to seeing on a day-to-day basis. This is slightly more advanced, where you can make the case this is a skewed out of the money straddle, right? It'll give you similar looking risk graph, but you definitely have room to the downside. You have room to the upside. And if this underlying chops in the meantime, these are the projected T plus 0 lines over time, right? The red line is T plus 9. The next line is T plus 18, right? So 18 days from now, this little ball here, which is the price today, should be somewhere riding on this darker line. And look at your break evens, right? If today, right, the stock doesn't need to go much higher before your trade goes in the red. Well, looking at the red line, which is T plus 9 days from now, your break even is out to about 140. And then 18 days from now, your upside break even is out to about 146. So time is on your side here. Time is on your side here. And you have short delta throughout the whole time. So if you're short term bearish, you can sell, slightly out of the money calls, at the money calls. Again, there's no right and wrong, guys. If you're just looking for right, you will spend the rest of your life looking for right. You'll never find it. You need to figure out what's right for you, and that's what's right. So you need to understand where this trade makes money. You want to understand in what condition this trade makes money, and then apply whatever strategy makes most sense given your time frame, your price outlook, or whatever. Right? This is a pretty good trade if you're long term. You don't have to be super bullish because again, your long term short put has a limited upside potential. Your upside or your profit potential is limited to the amount of credit that you have received. Your main income driver are these short term calls, and you can control your delta by moving these calls higher. Right now, you're short 6 delta. If you're a little more bearish, you move your short calls a little bit closer at the money. You take a little bit more premium. In exchange, you have a little bit more negative delta. So depending on whether you're more bullish, more bearish, or neutral, you move the calls around, and that's going to be a function of premium you're collecting, right? The safer your trade is, the more neutral you are, the less credit you're going to collect, right? Selling a 160 call only pays you $195 short term. Selling a 145 call will give you a lot more directional risk, which sucks. But in return, you get just, 2 times as much premium on the short call. So there's a balance, and you need to figure out, um, where that balance makes sense for you. Let's see. Hopefully this kind of answered your question, and right. But if you're looking at one more thing I want to add, if you're looking at the risk graph of this trade and compare this to a longer term in the money long call. Let me just clean this up real quick. Long term, long leap, and then to sell like a 30 or a 35 delta call against it, right? Slightly different risk profiles. Slightly different risk profiles. I would say if I had to compare these trades or the characteristics of both trades, I would say that both trades have negative gamma, which is a positive theta trade, which means in both scenarios, time is on our side. Both scenarios are not going to benefit from a spike in implied volatility. So we're effectively net short or with net option volatility sellers. I don't care what this Vega number says. That's not right. If volatility explodes here, it's not going to help this trade because my near term options are going to increase in price way more than my longer term options. And that's going to cause the P&L line to dip, and that's going to show a loss near term at least. It'll fix itself over time, right? We have to assume that volatility is going to mean revert, but this is not a long Vega trade. So if you're thinking that you're rebalancing your portfolio by adding these kind of trades because they will remove some of that negative Vega from your Strangles or straddles, that is incorrect. All right. Let's see. One captures the time value even when the call goes in the money. I think that we're talking about the in the money and out of the money, intrinsic versus extrinsic. Harry saying, to me, as more of an income investor, it is mostly about selling time premium. Leap growth is a bonus. Sure. again, the goal for the trade that I have in Microsoft, and right now this looks more like a beating than an income trade, right? The leap is definitely not giving us anything, but if we just able to ignore the noise, because again, if you're long-term bullish on the price of the underlying, it's going to work out. You always have to stay awake to understand where you are on your leap, right? If your leap is down so much that you have no chance of ever making any money, it's not too late at some point to say, you know what? Maybe this is not the trade I want to be in, or maybe I need to do something to it in order to, get a little more directional exposure. Because if I hold this long 280 call and Microsoft is trading at 250, right? And I still have $10 of extrinsic value to collect with only 1 week to go, it's very unlikely that this trade is ever going to turn a profit. But it's important to understand that this can happen and kind of price things out before this happens. If you realize that, oh my God, my leap is now only, maybe 2 months from expiration, I still have a ton of extrinsic value that I have never recovered with the short calls. And now I'm running out of time and the price is moving in the wrong direction. Well, you kind of overslept. You didn't act soon enough to fix your trade. And that's important to, constantly monitor and understand that, collecting near term premiums are great. It's great. But you also want to make sure that in the meantime, while you're collecting short term income with your air tags covered calls, you want to make sure that your core asset is not getting destroyed, right? So you have to have rules. At some point, if your core long position is down X, you may need to rethink. You need to always look at the chart. You have to have an opinion about, why did you pick this trade to begin with? Why were you bullish on Microsoft at 420 where it was yesterday? Now it's at 403. It's going the wrong way, but it's only one day in. There's still time. But if this doesn't change at some point, right? Hopefully the short term income trades are going to help to offset some of these losses. But if this continues for extended period, right, I'm going to try to improve my basis by scaling in, which is my plan, right? And but at some point, if things don't improve, you need to know when to cut the whole thing off. Harry saying Tom is selling the way out of the money puts as a way to get income and possibly take assignment and convert to a leap call if stock hits 80. Yeah, if we're still talking about a position in Palantir, then stocks at 140 or whatever it is, selling an 80 put, right? That put is out of the money. It has a long time away until expiration. And if the stock is down to 80, right, the trade may show a loss depending on how much premium was brought in by selling calls against the short put. Uh, Taking stock at 80 to convert it into a leap, right? So you kind of go from one trade into a poor man covered call or whatever that may turn into. But again, it's a great trade. It's a great idea. And it only needs great execution, right? If the idea is great, if the plan is awesome, but if for whatever reason, right, the stock that you were looking at, it goes from 140 to 120 to 100 and then now to 80, right? Your plan was to take stock at 80. Has anything changed? If no, you continue with your plan, which would be to take assignment, convert it into a leap, and blah, 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 right? But if the stock goes from 140 down to 80 and something has changed, you need to understand, are you still bullish long term? If the question is no, do you really want to take the stock and convert it into a leap? Because that would be a bullish position. And if you don't want a bullish exposure to stock that's trading from 140 down to 80, why do you continue to follow through on that plan, right? You need to know when you need to bail and potentially get out of a trade before goes, from bad to worse. So, but I think the idea is solid, right? Um, Long-term leap, if stock goes down, you take shares, you turn around, get rid of the shares, pick up a leap, which is going to be very efficient on capital, and then you sell covered calls against it. And then again, over long periods of time, hopefully you will be able to capture enough short-term income from these short calls to get you to at least a break even. Because look, with these kind of trades, the underlying can go down, right? And if it wouldn't be for these short-term income trades, your position would be at a drawdown or at a loss. But if you're able to use short-term income trades to offset or to cut your bases down or generate income that will offset some of the losses on your core or a longer term bullish position, right? I think Tom has shown a great example in some of his trades where the underlying hasn't done anything, but he's way up because, week to week premiums that he's selling, it may not seem like a lot. And sure, some trades may start out a little slow and it feels like you're just not really getting anywhere. But over long periods of time, it starts to really add up. And then your return on basis starting to look a lot more attractive once you start to apply that premium that you're collecting to reduce your cost basis of your long-term assets. All right. If you have any questions, I know we kind of covered a few things and we talked about these poor man covered calls. And if you have any questions about anything we talked about today, you can ask questions on Discord always. I encourage everybody to ask questions. If not, I'll be back on Friday. We're going to look for some trade setups. I'm looking for SPX bear trap. Not sure, depending on where the market is by Friday. I'm going to try to add something to the couple of positions I have on right now. Let's see what we have cooking in SPX. So this is a trade that's 19 days in with 23 days to go. It's currently showing about a 6.5% return on margin. Margin was just over $4,000. There's still 23 days to go with about $700 to be made. I'm not going to hold this until expiration. I was looking to be out of this trade hopefully this week, but the profit is about halfway to where I was looking. And there's nothing wrong with taking the trade off a little bit earlier. The most recent trade I put on is this. This is 8 days in with 37 days to go. Margin is $4,075. It's currently up about 2% on margin. So, in the last 8 days, the underlying hasn't really moved a whole lot. Volatility is kind of flat. So, if we chop sideways, this is the best for this kind of a trade. But if we chop sideways and volatility starts to creep up, it's really not going to help this trade a whole lot. But sometime this Friday, I'm going to look for something similar. I'm just not sure how I'm going to set up a trade, depending on where the market is going into the end of the week. Maybe we'll set up that looks something like this. If the market's more bullish, we'll try to reduce upside risk and restructure risk a little differently. We will take a look at all of that on Friday. If you have some ideas, if you have some topics you would like to discuss, those are also very welcomed. Let me know on Discord. Otherwise, I'm going to run here. Have a good day. Until next time, guys. Take care, everybody. Bye bye.